Analyze types of risk. Introduction to risk and its dimensions. Risk represents the possibility that actual outcomes will deviate from expectations, either positively or negatively. It arises from uncertainty inherent in all business activities and decisions. Traditional management accounting treated risk primarily as a negative factor, potential loss or failure. However, modern frameworks recognize that risk has both upside and downside dimensions, reflecting threats and opportunities. This dual perspective is vital for strategic management because it enables firms to exploit positive risk outcomes such as innovation, market expansion, or cost advantage. According to CIMA, analyzing risk involves identifying sources of uncertainty, assessing their potential impact, and quantifying likelihood where possible. This analysis forms the foundation for informed decision-making and performance evaluation. A systematic approach ensures that risk assessment supports not only resilience but also value creation, transforming uncertainty into a managed strategic resource rather than an unmanaged hazard. Upside and downside risks. Upside and downside risks represent two complementary aspects of uncertainty. Downside risk refers to potential losses, events that harm profitability, cash flow, or reputation. Examples include equipment failure, regulatory changes, and market downturns. Upside risk, conversely, refers to opportunities, factors that can lead to improved performance, such as successful innovation, favorable exchange movements, or unexpected demand growth. The challenge for management is to achieve an optimal balance between risk aversion and opportunity exploitation. CIMA's guidance emphasizes that an integrated risk analysis considers both perspectives simultaneously. Quantifying upside risk ensures that strategic opportunities are pursued systematically rather than reactively. Ignoring upside risk can result in lost growth potential, while ignoring downside exposure can threaten survival. Therefore, risk analysis must align with corporate strategy, recognizing that sustainable competitive advantage depends on intelligent risk-taking supported by robust management information systems and forecasting techniques. Categories of business risk. Business risks fall into several broad categories: strategic, operational, financial, and compliance. Strategic risks arise from changes in market conditions, technology, or competitive positioning that threaten long-term objectives. Operational risks stem from failures in processes, systems, or human performance that affect day-to-day efficiency. Financial risks involve exposure to market volatility, interest rate fluctuations, credit defaults, or liquidity shortages. Compliance risks concern breaches of laws, regulations, or ethical standards that can damage corporate reputation or lead to penalties. Analyzing these risk types enables managers to allocate resources effectively and design appropriate mitigation strategies. CIMA recommends linking business risk analysis to key performance indicators, KPIs, so that risk management becomes integral to performance monitoring. By classifying and quantifying risks, organizations improve resilience, stakeholder confidence, and decision accuracy across all levels of management control. Quantification and assessment techniques. Quantifying risk transforms qualitative uncertainty into measurable data, enabling objective comparison and prioritization. Techniques such as probability analysis, expected value, and standard deviation measure variability and potential impact. Value at risk, VAR, and sensitivity analysis help assess exposure under alternative scenarios, while risk mapping visually ranks risks by likelihood and severity. CIMA advocates integrating these quantitative tools within management accounting systems to improve decision-making precision. Effective risk assessment also involves distinguishing between controllable and uncontrollable factors, those within managerial influence versus external forces like macroeconomic shifts. Quantification provides the foundation for determining appropriate responses using frameworks like TARA. However, excessive reliance on quantitative models can overlook behavioral and ethical dimensions of risk, underscoring the need for balanced judgment combining data analytics with managerial experience and contextual insight. The interrelationship between risks. Risks seldom exist in isolation, they interact dynamically across business functions and time horizons. For instance, a strategic decision to outsource production might reduce operational costs, upside, but increase supply chain risk, downside. Understanding interdependencies allows management to anticipate cascading effects across divisions or geographies. Correlated risks can amplify volatility, while diversification can reduce aggregate exposure. CIMA stresses the importance of systems thinking in risk analysis, recognizing that changes in one variable can influence others through complex feedback loops. Enterprise risk management, EIM, frameworks support integrated evaluation by combining qualitative assessments with quantitative modeling. The goal is to view risk holistically, aligning exposure profiles with organizational risk appetite. This interrelationship perspective ensures that management decisions support both resilience and opportunity exploitation within a controlled governance structure. Role of management accountants in risk analysis. Management accountants play a pivotal role in identifying, measuring, and communicating risk information across the organization. They provide the analytical capability to translate uncertainty into actionable insights. Their involvement ensures that risk analysis aligns with budgeting, forecasting, and performance evaluation systems. CIMA emphasizes that accountants should not merely report risks but interpret their financial and strategic implications. This includes advising on capital structure adjustments, evaluating hedging strategies, and assessing risk-adjusted returns. Through scenario modeling, they enable management to test strategic assumptions and prepare for contingencies. Ultimately, the accountant's role in risk analysis extends beyond compliance. It contributes to strategic foresight, helping organizations navigate uncertainty while maintaining focus on long-term value creation and ethical governance.